Uber is a rapidly growing yet deeply unprofitable company in an increasingly competitive industry. Soon, it could be worth $100 billion.
Uber was born out of a watershed moment in technology. The rise of smartphones, the advent of app stores, and the desire for on-demand work supercharged Uber's growth and created an entirely new standard of consumer convenience.
The company plans to go public, reportedly in the next few weeks, to raise around $10 billion. But its prospectus released on Thursday paints a grim picture of Uber's finances. The firm lost more than $1.8 billion last year. Despite its continued growth, revenues rose 42% to over $11 billion in 2018. But the growth was slower than the previous year, when the firm more than doubled its top line. Over 91 million people around the world use Uber every month. That's up by a third from a year ago. Uber's losses have reinforced doubts over the sustainability of the ride-hailing business. Rival Lyft is also in the red, and its shares have fallen 15% since going public last month.
We don't think Uber's worth anything close to $90 billion, probably half of that, just like we think Lyft is worth about half of its current valuation. This is about venture capitalists and private equity cashing out at the expense of the public, and I am sick and tired of it. People need to not buy these stocks.
Uber's investing in businesses like food delivery and logistics to develop new revenue streams, but those haven't paid off yet. The same goes for its venture into driverless cars, which suffered a setback last year after one of its vehicles killed a pedestrian in Arizona.
We will see self-driving cars going in highways as well as going within the city. And this, it has different difficulties whether it is cities versus highways. Cities are, there's a lot of people there, and people do a lot of things that you don't expect.
Uber's main ride-sharing business will continue to struggle amid competition from Lyft in the US and the likes of Ola in India. It's already been forced to abandon several Asian markets due to local startups like China's Didi. The company that invented ride-sharing now relies on undercutting those rivals to gain market share. But it'll need to convince investors it won't be burning money forever. Paolo Montecillo, TRT World.
Well, to steer us through this story, let's go to TRT World's editor-at-large, Craig Copetas, who joins us from Paris. Hi, Craig. We know that before companies go public, they must disclose their finances, but Uber has gone a step further by warning that the company may never, ever turn a profit. Why then would investors buy their stock when they finally do go public?
Why do people go to zoos, Oscar, even though they might be eaten by the animals? Look, let's go back. December 12th, 1980. I don't know if you were even born by then. However, I remember the day well. That's when Apple went public at $22 a share, and everyone was dumping on them. If you bought 10 shares, spent $220, you would today have in the neighborhood of $125,000 in your pocket. That's more than a 56,000% return. There is no power so strong as the possibility of enriching yourself.
So do you think, though, is it more a mob mentality that people just don't want to miss out on possible returns, even though the company's done everything in their power to tell investors, look, we may never make money?
Well, the mob has aspirations, and so does Uber. Uber wants to go beyond ride-hailing. They're into Uber Eats, Uber scooters, Uber bikes, Uber this, Uber helicopters, Uber that. They want to kind of like be the Amazon of transportation. Whether they can get there or not remains to be seen. But there is one wrench in this Uber deal that very few have been talking about. You remember Mohammed bin Salman and what happened to Jamal Khashoggi a few months ago in Turkey? Well, the Saudi Public Investment Fund, of which is controlled by the Saudi royal family and Prince Salman sits on, has about $4 billion in Uber right now. And in fact, could come out of this with a great profit, more than SoftBank or any of the other investors. So we think of Uber as a public green company. People are interested in it, millennials, young, hip, cool, savvy, aware of politics. Well, they don't seem to be stopping the flotation of Uber likely on the New York Stock Exchange because of the Saudi connection.
Interesting. Apparently, the last time unprofitable companies like Uber and Lyft went public at this rate was back in 2000 when we saw the dot-com bubble burst. Are we in danger of seeing history repeat itself?
History can always repeat itself in the market, Oscar, but it's very hard to predict. Is Uber overvalued? Why? Of course it is. They're hoping for like what, $55 a share? I don't think it's going to get anywhere near that. They're now saying $100 billion is expected. You know, they had expected $120 to $130 billion a few weeks ago. So, you know, what people think will be the share price will likely lower. If they go lower than $55 a share, Oscar, that's when we take another look and find out why. Because in the end of the day, I don't think many people would agree that Uber is the next Apple.
Okay, we'll see what happens when they finally do go public. Craig Copetas in Paris, thank you as always.